Welcome to this deep dive. Today, we are analyzing the macroeconomic shockwaves that hit the digital asset space between May 12th and May 13th, 2026.
Glad to be here for this one.
Our mission for you today is to really unpack how a hotter-than-expected inflation print, along with the just-reported PPI numbers, is simultaneously triggering a reshuffling of institutional capital while also accelerating Wall Street's permanent integration of blockchain infrastructure.
Yeah, it is a truly bizarre split screen we're looking at right now. And to understand the sudden shift in market structure, we really must start with the exogenous macroeconomic trigger.
Right, the April CPI data. So headline CPI advanced 3.8% year over year, which obviously beat the 3.7% consensus.
Exactly. And core CPI rose 1.4% month over month. And like you mentioned, those newly reported PPI numbers are flashing the exact same inflationary warning signs.
Yeah, the drivers are super specific too. We saw a 3.8% surge in the energy index and a pretty massive 5.4% jump in gasoline, which is heavily influenced by those maritime escalations in the Strait of Hormuz.
Right, the shipping bottlenecks.
Yeah. Okay, let's unpack this. If the CPI spike is primarily driven by kinetic geopolitical friction in the Middle East energy supply chain, why are fiduciaries treating this as a systemic domestic issue that just paralyzes the Federal Reserve?
Well, it comes down to how inflation actually moves through an economy. I mean, fiduciaries aren't just looking at the Middle East and assuming energy prices will magically settle down. They're looking at the pass-through costs.
Ripple effects, basically.
Exactly. When energy and shipping get that expensive, it eventually shows up in the price of a local haircut or a cup of coffee. It seeps into domestic services. So the Federal Reserve's hands are effectively tied here.
Right, they can't execute near-term rate cuts when everyday services are still getting more expensive. So this hawkish reality directly explains the sudden paradox we are seeing in institutional behavior.
Yeah, speculative capital is fleeing, but the legacy banks are actually digging in.
Yeah, we saw the immediate ETF reaction, a $233 million aggregate net outflow. Fidelity's FBTC alone shed $86.1 million.
It is a significant short-term contraction for sure.
But wait, contrast this capital flight with the major structural integrations happening at the exact same time.
Right.
You've got Charles Schwab rolling out direct spot crypto trading to its 39.1 million retail accounts, charging a 0.75% fee.
Right, a massive retail gateway.
And JPMorgan just filed to launch JLTXX, which is a tokenized Treasury money market fund on public Ethereum designed specifically for stablecoin reserves.
What's fascinating here is that complete divergence. You have fast money macro funds ditching zero-yield assets because of those delayed rate cuts, but the legacy banks, they are systematically co-opting decentralized ledgers to dominate future fiat liquidity.
Right, they're ignoring the short-term noise. And, this structural evolution isn't just happening at the financial application layer, it's radically transforming the physical base layer infrastructure as well.
Yeah, the hardware side is shifting just as fast. Look at Bitdeer's April telemetry. While they mined 783 Bitcoin, their AI cloud annualized recurring revenue actually surged 60% month over month.
Wow, to what, $69 million?
Exactly. And they are deploying over 4,000 advanced GPUs, Nvidia H100s, mostly and actively negotiating AI tenant integration in Norway.
I mean, it's like these modern industrial miners have realized they're actually massive energy landlords.
That's a great way to put it.
Yeah, they are pivoting from just self-mining to renting out their premium gigawatt grid access to AI hyperscalers.
Because the AI sector is absolutely desperate for power. The physical hardware underlying this asset class is bifurcating. They use the blockchain for a steady baseline, but they're actively provisioning the raw electrical power for the global AI boom.
So to wrap this up for you listening, while that sticky CPI and PPI data is causing a short-term ETF capital contraction, the actual bedrock of the ecosystem is permanently merging with traditional finance and global AI compute infrastructure.
The foundation is getting cemented, regardless of the macro anxiety.
Which leaves you with one final provocative question to ponder. If Tier 1 global banks like JPMorgan are now legally structuring sovereign-grade Treasury collateral directly on public blockchains like Ethereum, what happens to traditional Wall Street clearinghouses when the primary settlement layer for U.S. dollars operates entirely on-chain, 24/7?